today we're going to explore possibly a low fee 1031 solution. And so this is a great one if you are shopping around, and we like to offer different solutions here. So really excited about what we're going to hear today. And for those of you that don't know, AOA has been around for over 40 years. We have one of the largest individually organized groups of apartment owners here in the state of California. And really our goal is to provide you with ideas and tools that will help you make and or keep more money because of it. So we really feel that your $97 investment, we think we can help you make and or keep way, way, way more than that. Hopefully we're giving you $1 million ideas and that help you become more successful. And really, yeah, so we want to keep you in the know. If you've never been a member, you get 100% money back guarantee in your first year. And man, we have been running and gunning, trying to get the word out with the Prop 33 that will be on the ballot in November. You see the sign behind me, the Pinocchio. They definitely get a Pinocchio for trying to call this justice for renters. It's couldn't be further from the truth. And when you put extreme rent control, like what they're looking at by repealing Costa-Hawkins, man, it's a nightmare for renters. Their quality of living goes down, and of course, the value of your property goes down, and just all the extra regulation, vacancy control, and everything else just makes it a nightmare all around. Thank you so much for those of you that have been donating to the AOA Political Action Fund. And those signs we have as billboards, and we are trying to raise money to put up as many of those billboards as possible. And anyway, so hope that you're able to get something to that. And then also, man, we have a bunch of new forms that are coming out here in the next couple of days. There's a couple for employment purposes, pre-screening, adverse action, as well as a new adverse action form for renting, and a new disclosure that includes both California and the federal disclosures that need to be shared before you give a rental application. So there's a whole bunch of stuff coming up. And then in addition to all of that, we do have more live streams. Of course, next week, we will have a resident manager attorney speaking, and he'll tell you, share with you strategies to avoid some of the pitfalls in hiring. There's a whole lot of the litigation that's happening is happening around the hiring aspect. And then, of course, paying resident managers is the other big place. So he's going to cover that. And then on the 19th, we'll have a one that's specific to LA area, and it's rental assistance application and how it affects landlords. And so those are questions that we get in. And so we're providing that content. Excited about that in person. If you remember, it's free. On the 17th, it's going to be awesome in San Diego at the Marina Village. So nice. Get there early, eat lunch on the in the wharf there. It's so beautiful, and the lunches are great and cheap, by the way. So come on out. That's going to start up at 2:00, and we will have that resident manager attorney speaking. And also we will have Franco Simone, the landlord tenant attorney, speaking. And so about habitability, maintenance, and related things. So those are going to be two great seminars in person. 25th in Hawthorne, we're going to have a habitability seminar just like in the one in San Diego, but with Mike Brennan. And then we'll also have a guy that's been around the block and just has so much experience when it comes to setting up LLCs, structuring everything for maximum tax savings, and then also asset protection. So that's going to be coming up in Hawthorne on the 25th. We hope that you guys are able to attend some of these. And so without further ado, we're going to get into it. We want to thank Origin Investments for sponsoring this live stream today. They are a private real estate manager that helps high net worth individuals, family offices, and advisors grow wealth through tax-efficient real estate solutions. They build, buy, and finance multifamily projects in fast-growing U.S. markets, and offer 1031 exchanges through their Origin Exchange platform. In 2023, they launched Origin Credit Advisors, providing yield-focused multifamily debt investments. And so with them, we have our speaker today, Michael O'Shea. He leads Origin Exchange, and with over a decade in alternative investment industry, he has helped syndicate over $10 billion in commercial real estate, including $500 million in 1031 exchanges. Michael holds an MBA from DePaul University and a bachelor's from Purdue. He's a CFA charter holder and lives in Elmhurst, Illinois, with his wife and 3 kids. He's a sports fan. And anyway, we'll learn a whole lot more. Michael, please, it's great to have you on, and give us a little bit more of an introduction and just take it away.
Yeah, Jeff, well, thanks for that great introduction. Yeah, big sports fan and kind of timely. We could spend the whole conversation, I think, talking about the Chicago Bears. We were just recently on Hard Knocks, and I'm ready to run through a brick wall after watching all 4 of those episodes, and we're going to kick off this Sunday, so ready to go there. But I think today we wanted to focus a little bit on real estate advanced tax strategies, and kind of before I get into the presentation, we've recently started building a relationship with the California Apartment Owners Association. The genesis of this presentation was actually one of our current clients, who I'd assume is on the call right now. I had a call with them at the end of last year, and they said, "Yeah, I'm really familiar with Delaware statutory trusts and 1031s. Essentially, we just think the fees are too high, and that's not something that we would ever look into." And at Origin, that's essentially why we built this platform. The fees are too high, and we've come in with a low-fee DST solution that's built for the institutional real estate investor, the professional real estate investor. We're putting more of your cash to work, and we think this is going to be an elegant solution for clients that are looking to get out of the active management of real estate and retire passively. So let me share my screen here and sort of jump into the presentation. And how does that look on your end, Jeff? Can you see that quite well?
Yeah, that looks good. Oh, actually, now for me, I see a next slide also pops up. And Israel, you can chime in if what you see is different.
How's that? Is that better?
There we go. You got it.
Okay. All right, great. So I think this presentation is designed for more of an hour-long presentation where we go through all the do's and don'ts of 1031 exchange. I think for purposes of this presentation, this is meant to be a little bit more simple, a little bit more efficient. So I plan on just speaking for about 20 minutes and condensing a lot of this information into a very quick timeline. Up on your screen, you'll see a booking link. So if you have a property for sale, something you're thinking about selling, if you want me to run a spreadsheet for you that determines your potential tax liability or how an Origin investment would look versus another DST that's in the marketplace, just use that booking link that's right on the screen there, and that'll just find 30 minutes on my calendar and your calendar, and we can talk some specifics, because we certainly are not going to get into a lot of detail on this presentation. I think most people on this call would be wondering maybe who Origin is. We're a Chicago-based company, but we don't invest in Chicago for a multitude of reasons. We were founded in 2007, essentially as a family office. And I think it's that founding, that origin of our company, that's one of the differentiators from a lot of real estate firms that are out there. We were essentially started as a family office. Our 2 founders, Michael Episcope and David Shear, they built their wealth as derivatives traders in the late 90s, early 2000s. And at that point, they had built enough wealth where they needed to preserve and protect their capital. What they found out in the marketplace didn't suit them. It was too risky. The GPs made money and the LPs were left holding the bag, etc. And as they started talking to each other, they just thought, we could do this better. And so they built Origin. for themselves. They put their own capital to work in real estate. And the way they thought about risk from being derivatives traders was just a little bit different. We played on the credit side. We did some opportunistic deals. And now you take that from 2007, fast forward 17 years, we now have over 4,000 individual investors with Origin and 90 registered investment advisor partners that allocate their clients' capital on their behalf. And so we've continued to grow. And through the use of opportunity zones, we became one of the largest opportunity zone syndicators in the United States. And then with that tax-based focus, a lot of our investors were calling us and asking us, can you offer a 1031 exchange solution for us that's in line with what Origin currently does? And so we brought it out into the marketplace. And so we've been building a 1031 solution, but if we were going to do it, this would be something that Michael and David would put their own personal capital into. And if you look at the DSTs in the market, the front end load could be as high as 15%. And that is absolutely not something that they would do. And so we've streamlined it and made it more investor friendly with better outcomes and better overall returns. And so I think you're going to be pretty interested in what you hear. Kind of looking at this map here, we invest in the path of growth. We only do multifamily. We do not invest in industrial, office, retail. We only do multifamily. We're a data-driven company that uses machine learning models to help us determine the best markets. And you can see the path of growth. The white dots are where we have offices, and the highlighted blue states are where we focus. So think the Carolinas, Florida, Texas, the Front Range of Colorado, Salt Lake City, Nevada, Las Vegas, Phoenix. So that's where we focus all of our efforts. I've been doing this for about 17 years now, and I've seen the good, the bad, and the ugly with the 1031 exchange market. And I've come on board at Origin to specifically help build this platform. Now, in this presentation, I mentioned we're going to fast forward through quite a bit of this stuff. I assume because you chose to join this presentation that you're going to be relatively familiar with what a 1031 exchange is, how it benefits you, the tax consequences of investing. But if you would like to calculate your personal tax savings, this is something that we have available at origininvestments.com. I would encourage you to check out origininvestments.com. We lead with content. There's lots of webinars hosted by Michael and David talking about credit, talking about equity, talking about what we see in the marketplace. Our top 10 predictions for the year are always on there. Lots of great resources about real estate that you can learn. If you scan this QR code, it'll take you directly to our calculator. You can input how much I'm selling my property for, what did I pay for it, how much have I depreciated it, and it will actually send you an estimated PDF one pager that you can print out and keep with you as you're on your 1031 exchange journey. All right, so let's get into some of the fundamentals. We will go relatively quickly through this. Everybody mentions the 180 days when you talk about a 1031 exchange. While that is true, I always remind people of the 45 days, because if you are going to do your own 1031 exchange, from the time you sell your property, you have to identify a replacement property in 45 days. That is essentially the light speed in commercial real estate. So if you get an offer on a property and say, man, this offer is too good to pass up, can you find something in 45 days? Can you match debt? Can you match equity? Do you want to manage the new property? Our solution eliminates all of those challenges and can help you get something done quite quickly. So as you know, the properties have to be like-kind to each other. You can sell multifamily and exchange it for hotels. It doesn't have to be multifamily for multifamily. It just has to be real property that's held for investment purposes, exchanged for the same. So you'll notice on this list, there's two securitized interests that qualify. One is a tenant in common, one is a Delaware statutory trust. Tenant in common, all major decision rights have to be unanimous. You can only take 34 investors. So for many reasons, we do not do TICs. We do Delaware statutory trust. We can take up to 2,000 investors. The sponsor is in charge of all major decision rights, et cetera. And it helps us pool investor capital together into a higher quality asset. You'll notice that REIT shares, partnership interests, inventory, personal property are no longer or not allowed for a 1031 exchange. Personal property used to be, but it was actually the Jobs Act that repealed that. And what replaced being able to 1031 exchange personal property was qualified opportunity zone funds, which Origin also syndicates. So if you are selling personal property, if you're selling a business, if you're selling appreciated stock, you can take a look at our opportunity zone funds, but those would not qualify for 1031 exchange. The big one is a qualified intermediary. Of course, you have to get in front of a 1031 exchange. If you know the closing date is coming up, you have to find this QI ahead of time. It's as simple as filling out a form online, opening up an account, and the QI has to take possession of the proceeds during the exchange. If you need a referral to a qualified intermediary, we work with several throughout California that we'd be happy to introduce you to. Same taxpayer rule. So if the property is owned in an LLC with members A, B, and C, a lot of cases, member A says, I want to do a 1031 exchange, but members B and C don't. It's the LLC that has to be on the title of the replacement property. So there's a couple ways that we can work out that solution where one of the members wants to do a 1031 exchange and the others don't. One is a drop and swap. One would be to buy the other partners out. One would be a partial exchange. And then one of the most elegant solutions is to do a 721 UPREIT, which we'll talk about in a moment, where you can simply retitle it tax-free from an LLC into individual ownership. The last three kind of rules that you have to follow for a 1031 exchange all sort of rhyme with each other. So the easy way to think about this is that you have to replace the full value of real estate and you have to roll over 100% of the equity from the sale. So here's just a couple examples where somebody would fail. We're going to use the same example on the left a couple times. Really simple. You're selling a building for $1 million with $400,000 debt, $600,000 of equity. And let's say you roll that into a property where you find a $1.25 million building. You talk to a bank and they'll give you a loan at 60% LTV, and you've got $750,000 of debt. In that case, you said, well, I don't need to roll over all the equity from this deal. I'll just roll over 500. Now I've gone up in value. I've gone from $1 million to 1.25, but because you haven't rolled over all of your equity, that $100,000 is considered cash boot, and that is taxable to you, even though you've gone up in value. The opposite side of the spectrum, let's just say, hey, I'm done with debt. I'm not interested. I've got $600,000 from this sale. I'm just going to put it into a property with no mortgage. Well, you've rolled over all of your equity, but you've gone down in value. So now you have the opposite boot. It's called mortgage boot, and that's to the tune of $400,000 of debt relief, which is also taxable to you. So what would be the solution? One is you can add leverage. So let's just say that same example, $600,000, no debt. All you would have to do is find a replacement property that has debt. So you roll over your cash, you assume $733,000 of debt. Now you've rolled over all your cash, checkbox 1. You've gone up in value in real estate, checkbox 2. And so now you are tax-free. The other solution, if you have the cash and you wanted to be debt-free, you could add cash to one of these deals. So you can replace mortgage with cash. So in this case, you have $600,000. If you have another $400,000 from another source, you could roll that into the 1031 exchange by adding cash, and that would also be tax-free. So simple takeaway, roll over all your cash and replace the full value of the real estate. Now, we use a Delaware statutory trust. This is simply a wrapper that allows us to pool investor capital together. We have a full revenue ruling on this, 2004-86, that states that an interest in a Delaware statutory trust will qualify as like kind for the purposes of a 1031 exchange. And so the DST is just a wrapper. The DST owns the property, and what you're investing into is an undivided fractional interest in the DST. The main benefit is that it allows you to go from active real estate to passive. So say you're selling $1 million duplex in California, and it's taking up all of your time and work and fixing toilets and tenants and trash. And we syndicate, let's just call it a $100 million apartment complex in Dallas, Texas, or somewhere in the path of growth. This gives you the opportunity to sell your property in California, lock in all of those profits, roll the proceeds into a high growth state like Texas, and then you'd own 1% of this larger institutional asset where we send you a check every single month and we manage the asset for you. So it's still going to generate a monthly income stream. You're upgrading into an institutional quality asset, but the key benefit is that you're exchanging out of that day-to-day management. This is a portfolio. These are just a couple pictures of assets we have in our portfolio, just to kind of give you an idea of the type of quality institutional multifamily assets that we typically put people into. Now, this is kind of the premise that I wanted to focus on today. A lot of the people, and of course I mentioned earlier, the genesis of this presentation was speaking to an AOA member that said, I'm not interested in DSTs because their fees are too high. We couldn't agree more. DSTs is just a legal structure. What's happened with DSTs in the last 10 to 15 years is they've been flooded with fees to the point where sometimes it's 10, 15, 20% of equity. Meaning if you put $1 million into a DST, sometimes you're paying $200,000 in fees and $800,000 is going to buy real estate. The problem with those fees is they're hidden. Most people don't know, if you're not reading that private placement memorandum, that there's tremendously large broker commissions, selling commissions, finance coordination fees, dealer manager fees, etc. And so at Origin, we go directly to the investors. Remember, we have 4,000 individual investors, just like yourselves, that work with us on a day-to-day basis. We process your paperwork. We have a full investor relations team that can work with you daily. There is no need for middlemen. There is no need for brokers. There is no need to pay all these commissions. And so at Origin, we completely eliminate that front-end load. So instead of putting 85 cents to work in a deal, at Origin, you'd be putting closer to 97 cents to work inside of a deal. We're very upfront about our fees. We charge a 1% acquisition fee, and then we get reimbursed for organizational and offering expenses. That's it. And if you notice about acquisition fees, if you do read a PPM, there's some companies that say, oh, we don't charge an acquisition fee. And all they did is change the name. They call it a syndication fee, coordination fee, whatever it is. It's a 1% fee or higher for putting the deal together. So we're very upfront. That is the only revenue source that we make on these deals. That gets paid to us. Oh, and you can think about like outside legal counsel that helps us put the documents together, traveling to conferences to put on presentations and educate the marketplace. Those are simply costs that we bear that we get reimbursed from the fund. So the only thing that actually hits our revenue is a 1% to 1.5% acquisition fee. That means a lot more of your money is going to work. So if you think about the back end of the typical DST, it's what they call swap until you drop. So you roll your capital into a DST, paying all of those fees. 5 to 7 years later, that DST will sell, and you'd have another 45 days to roll it into another DST. Well, that's got a couple risks. Number one, you have idiosyncratic risk. That means you're owning a single asset for the rest of your life. It's either this apartment, this building, this building. You're going to own one asset, and the value of that portfolio allocation is tied to that single asset. So think about owning a single stock versus owning a mutual fund or ETF. You want to diversify your portfolio. Number two, there's operational risk. So who knows in 5 years what the market's going to be like? But no matter what the market's like in 5 years, you're still going to have 45 days to roll it into a new property. You may not be able to match debt or equity. You may not like the new property, but you're still required to keep rolling and rolling. And then finally, you have to pay those fees, that front end load of 10 or 15%. You pay that every single time you roll. And so at Origin, we're employing a strategy that keeps you invested for the much longer term inside of a single portfolio. One of our main theses is the best path to wealth is to keep your capital invested for the very long term into efficient risk assets without the frictional costs of taxes and fees. And so the Section 721 or UPREIT, as some people refer to it as, allows you to do that very simply. So with a Section 721 exchange, it's a continued tax deferral. That monthly income still comes in. You're still rolling into institutional quality management. But the main benefit is you get to diversify your capital into a large portfolio of real estate. So you no longer have that idiosyncratic or single asset risk. You're now diversified. And then finally, from an estate planning perspective, when you are doing a 721 UPREIT, it's an easily divisible security that you can pass along to your beneficiaries with no burden of work, no fighting over the assets, and a fully stepped up cost basis with more liquidity than you would have in a traditional DST. So how does it work? Well, It's a two-stage solution. The first thing you do is a 1031. You would sell your property to someone else, not to us. You'd find a buyer for your property. The cash would go to the qualified intermediary. The qualified intermediary would wire the funds to Origin, and you would go into our DST. We have a DST right now available called Starling. That's down in Dallas, Texas. So your proceeds would roll into that building. You would own that building for approximately 2 years. And during that time, you would get all the cash flows paid monthly. You'd get any appreciation if the building goes up in value. You'd be able to write the depreciation off of your income taxes, just like normally owning any building. However, 2 years after owning the Starling, our flagship real estate fund, a diversified portfolio of multifamily assets, it's called Income Plus Fund. And the Income Plus Fund would actually buy the Starling asset from you. Instead of giving you cash, we would give you operating partnership units in the fund. And when that happens, you now are diversified across the entire base of the Income Plus Fund, as I described earlier. And so that is an option of Income Plus Fund. It may or may not happen, but the Income Plus Fund has the right to acquire this DST asset 2 years after we've syndicated it. All right, so wrapping up quickly, I think I mentioned earlier on the call that we think one of the best paths to wealth is to stay invested for the long term and not pay all the taxes and fees that come with liquidating assets. Our friend at Berkshire Hathaway, Charlie Munger, who actually passed away last year here pretty recently, he's got so many great quotes, but one of my favorite ones is this: the first rule of compounding is to never interrupt it unnecessarily. Keep your capital invested, keep your capital growing. And so what I wanted to model here is exactly what I was talking about earlier. You sell $1 million building and you have maybe a $300,000 tax liability. That's what we're talking about here. And you have three options. I could pay the taxes and I could invest it into a 60-40 portfolio. That's 60% stocks, 40% bonds. That is outlined in the red here. Your other option is to roll into a traditional DST, where every 5 years, I'm paying those front-end fees again. Your third option is to invest it into a 721 UPREIT, and that is the blue option here. So as you can see from paying the taxes, you start at $700,000 because $300,000 is gone in taxes. So it's almost impossible to catch up to the staying invested as opposed to paying taxes. So let's kind of examine swap till you drop versus 721. Well, believe it or not, both of those bars are modeling the exact same rate of return on an annualized basis. That's 10% annualized rate of return for both of those bars. The only difference is the blue bar is staying invested for the long term, and the gray bar is paying those fees every 5 years. And you can kind of see that with the dip here in year 6 and the dip here in year 11. That's because you're paying those front-end fees. The problem, as I mentioned, with the hidden fee nature of this is that the person in the gray bar solution would probably be pretty happy. You turned your $1 million investment into about $3 million over a 15-year time period. If you would have been invested into a 721, you would have turned your $1 million into almost $4 million. It's actually a 23% increase. That's earning the exact same rate of return. Now, we think we will earn a higher rate of return. One of the other problems with staying in a single DST forever is that DSTs have handcuffs on them. And that is, they are not allowed to refinance debt. They're not allowed to renegotiate leases. It's called the 7 deadly sins of a DST. And if you do a swap till you drop forever, you are stuck with those handcuffs on your portfolio forever. Once you roll into the Income Plus Fund, the DST gets dissolved. And we can go and seek out the best risk-adjusted returns at that time, whether that's to build, whether that's to buy, whether that's to lend. And so we do think we will outperform the DST over the long haul. But just for the purposes of this presentation, to keep apples to apples, this is modeled as both of them earning the exact same rate of return. And of course, almost a 70% increase in wealth over paying taxes. So we think this solution could work quite well. And again, in the interest of brevity, I'm going to go through the Income Plus Fund quite quickly here. I mentioned this is our flagship real estate fund here at Origin. We do value add, we do core plus, we do some lending, we do some ground up development, we do some preferred equity. Whatever makes sense in the market, we will be investing in an Income Plus Fund across that risk return spectrum. Again, we only focus on multifamily, and we only focus on those 12 target markets that we've identified. The goal of Income Plus is exactly what the name says, income plus growth. It's meant to generate income for you. And so right now it's kicking off a 6.3% distribution. We're targeting anywhere from 5 to 7. And so think about from a very simple perspective, we're targeting 6% dividend, 4% growth. We're targeting a 10% annualized rate of return. Why do we like multifamily? Well, the main reason is it's got the best risk-adjusted return of any asset class in the market. It is a need, it's not a want. And we are severely underhoused in the United States. And so we focus on multifamily for all those reasons. We're extremely bullish over the next decade on what's going to happen with rent in the target markets that we are invested in. And then finally, the Income Plus Fund allows us to be tactical. So in the last couple of years, we haven't bought any core assets whatsoever. And that was because we saw interest rates were going to go up. Well, if you buy a core stabilized asset and interest rates go up, it's a lot like owning a bond. When interest rates go up, the value of the bond goes down. And so we chose to lend. We chose to buy into preferred equity positions. And that's really protected our portfolio over the last couple of years. And you can kind of see the cumulative growth of the Income Plus Fund. By the way, if you're looking for more real estate exposure and you don't want to do a 1031 exchange, this is a fund that you could just put cash directly into and just enjoy being, having an investment in the Income Plus Fund. But this is also where you would end up if you did a 721 UPREIT through Origin Exchange as well. And so I think the proof is in the pudding. I know NCREIF Odyssey Index down there is kind of a mouthful, but think about that as like a index of private real estate funds that are core diversified. They own industrial, retail, office, but they're very core stabilized assets. And look at what's happened over the trailing 1 year. Now, most people wouldn't write home and say, man, Origin, you're up 2.3% trailing 12. That's really great. That's okay. But we're in a very anomalous market where interest rates went up 500 basis points, right? And so look what happened to the market. They're down 12, we're up 2. That's a 14-point delta. At $100,000 investment, that's a $14,000 difference to your portfolio because of the way Origin Income Plus Fund positioned itself. So we think we have a couple really unique solutions. We're going to put a lot more of your capital to work, much lower fees than what's out there in the marketplace. And then number two, the Income Plus Fund is this all-weather fund that's allowed to manage tactically. So if you're going to date the DST, but like marry the Income Plus Fund, because that's how these strategies work, I think you'd want to be in a fund that's going to be able to shift what it's doing based on different economic environments to protect your capital for the very long term. So as I mentioned, there is a booking link there. You just click that, find a time that works for you, and it'll send a Zoom link to you and to I, and so we can discuss your case specifically. There's a QR code here. If you've got your phone out, you can kind of scan that, and that'll give you an opportunity to go to that same booking link, or you can just email me. It's Moshe, no apostrophe, so just MOSHEA at origininvestments.com. And I'd be happy to discuss your case with you as well.
Awesome. Thank you so much, Michael. Appreciate that. And if you could stop sharing your screen, we'll get a split screen of the two of us. And we're going to take questions now. So if you guys have questions, please go ahead and put those into the chat. If you're watching on AOAUSA.com, there's the blue help button at the bottom right side. You type your question in there, they'll get that over to me, then we can ask the question for you. And of course, this is on YouTube. Most of you are watching on YouTube or on Facebook. And then I think we're also on Rumble. So we're on several different platforms there. But just type your question in and get that over, and then we can take that. And I thought that was interesting that you're focused on multifamily only, and you briefly you covered it in one slide, but just that's real interesting and a little unique.
Yeah. Multifamily is a decision that we made as a firm, call it 15 years ago, and we're looking at the data and wanting to get the best risk-adjusted returns that we can out there. multifamily has had the best return per unit of risk compared to any asset class. We're very driven by data, and we built a machine learning model many years ago before everybody was talking about generative AI, because the data that you get in commercial real estate is not that great. And when we look at it and back test it, it's not that accurate. So if you are checking out the Origin Investments website, you may come across our Multilytics tool, and it's a predictive machine learning model that can help us learn what rents are going to do in certain marketplaces. So it helped us pick Jacksonville, Florida before most companies. It helped us pick Colorado Springs before most companies were there. And so when we look at the marketplace, Origin was one of the only companies in the United States that focuses on multifamily that actually predicted rents would go down in 2023 in aggregate across the United States. You have to remember, rents in 21, 22, they were up 10, 15% in a lot of markets. But we saw it. We saw it with the rising rates, with inflation, with the amount of new deliveries that were coming out to the marketplace, and we were right. It's exactly what happened. One of the things that taught us is that if you look at whether rents are going up or down in aggregate across the United States, it's only happened 4 times in the last 100 years that across the US rents have declined overall. 2023 was one of those 4 years. The other thing that it taught us is that it's a pretty good investment place to be. I mean, 96 times rents have gone up in aggregate over the last 100 years. So yeah, we love multifamily. It's all we do. We've got deal officers in every single market that we serve, boots on the ground that are there every week. And so there's not a single deal in our space that we compete in our markets that we're not seeing.
All right, so we have a question here from Alexander on YouTube. Does the 721 UPREIT keep adding properties to the portfolio forever? If they sell any property, does it trigger capital gains on the portion that was owned by the investor?
Yeah, that's a great question. So the way to phrase that is the Income Plus Fund will keep buying properties forever. So the Income Plus Fund is a perpetual evergreen fund. We will continue to raise capital from investors. We will continue to buy properties in there as well. The 721 asset that is that you would come in with, you are tied to. So if we sold that asset and had a capital gain, that capital gain would be distributed to those investors that came in with it. However, if you think about it from our perspective, we've approved all of these assets that we're doing a 721 for at the Income Plus Fund level, meaning we want to hold that for the very long term. Now, let's say hypothetically, maybe it just went gangbusters and we sold that asset for a really big profit, like too good to pass up. Well, you could still sell that asset, but inside of the fund, we would just take the proceeds from that sale and we would do a 1031 exchange inside of the Income Plus Fund. Therefore, there would be no taxable event to the investors. So that's how we plan to move forward with that.
Gotcha. All right. And Brian on YouTube, what do you get at year end? A K1 or 1099 YT? What do you get?
Yeah, good question. So while you're in the DST phase, it's a really simple grantor letter, 1 page. It's basically schedule of revenues and expenses, and then your prorated portion that you'd fill out Schedule E on your tax return. Once you are uprated into the Income Plus Fund and you own operating partnership units, you would get a K1.
All right, there you go. And Brent, what is the minimum investment amount?
Yeah, our minimum is $250,000 of equity, and we could be flexible on that. We're working on a couple cases. We've had exceptions, but that's kind of our stated minimum in our prospectus.
Got you. And you'd mentioned no selling fee, and explain, yeah, can you get into that a little bit? That's kind of one of the major fees that seems to be there.
Yeah. So when you say selling fee, I'm assuming you mean kind of like brokerage commissions.
Yeah, from your diagram there, you had a it's 5% selling fee. You had a picture of that there. And
Sure. Sometimes I think about it like insurance. So, you go to an insurance agent and you say, hey, I need life insurance, and they're going to show you Allstate and State Farm and MetLife and whoever they show you, and eventually you buy one of those products. That insurance agent is going to make a commission and you are going to buy a different product. Well, we are the Allstate. We are coming directly to you. So there's no need for us to pay commissions to any brokers out there, and that's just not how we operate. So all of that kind of like middleman fee that you think about is just cut out and completely removed from the deal. The way that DSTs are typically structured is kind of like a gross up. So if you buy a building for $100 million, then you'd put a $5 million gross up to pay commissions, maybe a $1 million gross up to pay a finance coordination fee, et cetera, et cetera, et cetera. Where for that $100 million building, you're actually paying $115 million for it. 15 is gone, 100 buys the property. With us, on a $100 million building, we take a 1% acquisition fee, plus we get reimbursed. So your $100 million investment, it might cost you 102, 103 million to get in. So all of those fees we're just eliminating by going directly to you, the investor.
Got you. And Alexander, do you sell only your own DSTs or also, for example, like the Inland DSTs? So are you the sponsor company? Inland's the sponsor company, right?
Yeah, Inland is a sponsor company that you cannot go directly to. If you wanted to go to Inland, you would have to go to a broker, and then the broker would invest your capital with Inland. So we would be like the Inland. Look, we are a sponsor like them. We are a real estate manager, but you can come directly to us to do your DST and save on fees.
Got you. And, with the Income Plus Fund, so if there's any place so basically it's a 2 years inside a DST and then it goes into the Income Plus Fund no matter what. Is that right?
Correct. So the Income Plus Fund has the right to acquire the DST, the Starling. If that right is exercised, the clients don't have a choice to opt in or opt out. Essentially, you're making the decision today by investing in our DST. You're basically saying, I want to get upgraded into your Income Plus Fund. So when that happens, you will be upgraded.
Great. And then, like at the very bottom, there's the little disclaimer, fair market value option.
Mm-hmm.
And so if you could delve into that one for people.
Yeah, sure. So like, what's the fair way to do it, right? It's like we syndicate this Delaware statutory trust, and then in 2 years, if we choose to exercise that option, we're going to buy it with stock. So what's the value of the asset in 2 years? Well, the only fair way that we can think of to do it is just get a third party. So we'll have a company like CB Richard Ellis or one of the big appraisal firms come in and kind of say what that building is worth in 2 years. And that will be the fair market value. And then we'll execute the transaction at that price 2 years from now.
Gotcha. Okay. Tom on YouTube, does your model take into account climate change?
Well, if you're talking about our machine learning model, Multilytics, absolutely. And I would encourage you to go to our website. Actually, our Multilytics prediction report just came out. So not only do we predict what's going to happen with rents in January, but we publish in June and December, like how we're doing, how accurate were we? So there's quite a bit of literature on Multilytics. We take in 9 billion data points a month. And when we back test it on whether a market's going to go up or down by 3% in NOI growth in a given year, Multilytics is 95% accurate. It's unbelievably accurate. And of course, climate change and what's happening with weather patterns and everything is factored into the model as well.
All right. Well, I think that's all we have on the questions. Let me see here. And so really the Income Plus Fund, that's really the thing that people need to understand how that works and what the risk is on that. So, we saw the diagram there. It looks like it's really done nothing but go up. And of course, past performance is not an indicator of future gains, right? But, what would you tell them if they were to ask you, well, how do I trust that? I'm putting all my eggs into that fund. That's one fund that, so what would you say to that?
Yeah, what I would typically say is if somebody's selling $1 million property, you're putting all your eggs into something, right? Before it was a 4 flat in California, all of your eggs were in that. If you chose to do a traditional 1031, all of your eggs would be in one building. If you roll into the Income Plus Fund, your eggs are now diversified across an entire portfolio. So knowing the fact that the 1031 requires you to roll over all your capital into something, you could argue that the income plus one is the least risky asset because of the diversified nature of the holdings, the institutional quality of the nature of the holdings, the institutional quality of the manager, et cetera. I will say you're right. If I was doing due diligence on this product, I would spend some time on the actual DST. Do I like this property? Do I want to be in it for 2 years? But I would spend most of my time doing research on Origin, the income plus fund. What kind of assets are you going to buy? What does your investment committee look like, et cetera? And I think you'd be really pleased with the more due diligence that you do. Mm-hmm. The last thing I would mention is Michael and David, who founded this company, they are our largest investors in all of our deals. They have $90 million of their own capital in our strategic credit fund, in our income plus fund, in our various funds that are out there. So you would be investing right alongside them and their capital into the income plus fund. And I think it's the more due diligence you do on that fund, I think the more that you would like it. It's a great place to be.
What do you think the secret to their success has been? So this kind of goes outside of just the deal itself, but yeah, just for those guys, what have you learned from them, or what do you think?
Yeah, I'm learning and continue to learn. They're different. The way they think about the markets is different. The way they think about risk is different. You mentioned I got my MBA at DePaul in real estate. So did Michael, and so. After he ended his career in derivatives trading, he actually went back to school at DePaul, which is a fantastic real estate school, just to kind of up his chops. And so we weren't in school together, but when I was there, he kind of came back and just did a presentation on Origin. Here's what we do. Here's how we think. And when he talked about some of the deals that they were, not only how they were sourcing the deals, but just how they thought about risk and what could be the downside and what's the tail risk and how do we think like not everybody else is thinking. And that leads into the data for real estate isn't good, right? So most people just go, well, everybody's got to deal with bad data, so let's just keep using it. Origin was like, no, we're going to build a model. And we built software. We hired engineers. We built, we hired a guy that's getting his PhD at Oxford right now as a data scientist who's running multilytics for us. So if something is not working, Origin will find a way. And so I think taking the biases out, using data, thinking about risk, is really kind of separated Origin from what's out there. And you see it in our returns. We're top decile returns with frequent across our portfolio. So it's been a really great fund.
And then when they get out of that fund, they'll pay capital gains tax at that point, unless they pass away, and then it would be a step up in basis. Is that right?
That's a good way to put it. Yeah. Like, so if you ever sell your interest in the income plus fund, that's going to be taxable to you. Of course, that's the way it always is. So if you think about you own real estate now, you could do a 1031 on your own, you could do an investment with us. But if you ever take any of that cash out of your principal and put it in your pocket, it's taxable. The only way to not pay tax on it is to pass away. Your beneficiaries would get a stepped up basis. At least with the 721, it's partially liquid. Whereas if you do your own or you do a swap till you drop, that's a fully illiquid investment. You have to wait for that to sell. With the income plus fund, we work on a redemption schedule. So if you had $1 million invested with us and you wanted to pull out 250,000 or half of it, you could just send us a redemption for half of it. Whatever your tax liability would be, you would have. But at least you have that option to pull out cash if you need to.
All right. Hey, Michael, thank you so much for taking time to share what you guys do and just help people understand that there's more options out there. And definitely, if they can see your contact information there, hopefully they'll reach out and get you some questions. It looked like they had, don't forget some of those resources they had, where you can see what your, how much tax you'd be paying. And what was the other? There seemed like there was one other that I'm just not recalling right now. You had some other things there on your website, I think.
Yeah, just we have the multilytics data, like what rents are going to do, predicted rents, and we have our top 10 predictions, a couple other webinars about the market. There's just tons of data on our website, so just click around and check it out.
All right, will do. Thank you, Michael. And thank you, everybody. We'll see you next week for sure. And if you're going to be in San Diego, we'll bring a bunch of those Vote No on Prop 33 signs. So come on out, get your free signs and post them up everywhere. And let's get the word out on that. But again, thanks, Michael, and we'll talk to y'all later. Bye-bye.
Thank you.